So now we're going to talk about various ways that you can allocate and or share, or not share, control. And it's an important concept, right? For the entrepreneur, they have a dream, they have a vision, and the investors have bought into that vision. By investing in the company, they're saying, yes, we like this vision, we like this management team, we think we can add some value, but the question is who gets to decide? There's a couple of ways that you can sort of allocate control. One is through a contractual agreement. That is to say, look, you get to do whatever you want to do, except if you do any of these things, you need our consent. Okay, so that gives the investor basically what's called protection. What kinds of things are we talking about? You can't go out and do a big deal without our consent. You can't go out and borrow a bunch of money that's secured by the company's IP, without our consent. We don't want you to do that. You can't sell additional securities without our consent, because that could be highly dilutive. Or maybe you can't sell securities that have senior or rights that are on senior or on parity. That's a common one. You can't grant a whole bunch of stock options at below fair market value without our consent. So those are typical kinds of protection provisions, and it makes sense, right? We're going to let you run the business, but for certain things, big things, you need to come back and ask for our consent. Now that's a contractual provision. Another way you can allocate control is through the board of directors. Again, sticking with this board of directors corporate governance model. And again, this is a general survey course, so I'm not trying to say that corporate governance in one country is necessarily the same as the corporate governance in other countries. But in general, it's true that the board of directors sets the overall policy and strategy for the company. It has to approve certain major events, issuances of stock, acquisitions, and perhaps most importantly, hires and fires the CEO. So if you're the founder, CEO, and you give up some board seats, but the board is still balanced, maybe it's not a problem. But let's say you lose control of the board early, and let's say you also agreed to a 4-year reverse vesting on your stock. You could find yourself on the unfortunate situation of being fired and having most of your founder stock repurchased at cost, and all of a sudden you're out on the street looking for a job. And maybe you deserve to be fired, maybe you don't, who knows, but it's an important consideration and one to consider. A couple of other ones that are worth mentioning, and by the way, this is not an exhaustive list of all the ways that you can allocate control, but one that's I think fairly important is the drag along right. So let's say that the company is approached by a third party, and that third party wants to buy the company. And let's say it's a pretty good exit. And some people think, yeah, we should exit now. There's a strategy where the buyer can take what we've built and take it to a completely different level. Maybe they have global distribution, global sales, who knows, whatever the reason is. And some people think now is a good time to get out. It's been a good run. Everybody's made money, let's get out. Others may have a different vision, which is, hey, we're going for the moon here. We're going to Mars, in fact. And, that happens. Mark Zuckerberg famously turned down Yahoo, who offered $1 billion for Facebook when it was pretty small. And at the time, people were like, wow, that's a big one to turn down. Or Groupon turned down $6 billion cash from Google. Didn't work out that well for Groupon. For Facebook, it worked out great. Look at Yahoo today and look at Facebook today. So, these are legitimate decisions by people to say, no, even though it's been a good run, don't want to do it. Now, what is a drag along? A drag along is basically a contractual right that says, if we get, say a majority of this particular class of preferred and we vote in favor of a transaction, everyone else has to agree to vote in favor of that transaction. So, as the name would suggest, you get to drag somebody along on that kind of a transaction. That's a control provision that's very important. Okay, one other thing worth mentioning is that we're talking about lots of different ways that you can structure these deals, and it can be complicated or it can be simple. In most cases, it's more complicated than simple. There are forms that exist, and as part of this course, we're going to make available to you through download a number of templates and forms and a series of different kinds of agreements, because it's important to note that there are lots of trade associations in the US. There's the National Venture Capital Association. There are lawyers and law firms that have created open source documents to try and make this easier. In Europe, most of the countries have some kind of a venture capital association. The UK Venture Capital Association has downloadable forms. The bar associations do this. So my goal here isn't to reinvent the wheel with my new form. It's more to make these forms available, because if it turns out that you are incorporated, for example, in Liechtenstein or Malta or Switzerland or wherever it is that you may be incorporated, those are the forms that you're going to need to use. And so in my experience as an investor, I've invested in companies all over the world. And when I invested in a deal in Switzerland last year, then honestly, I couldn't even read some of the documents. But I trust that the lawyers who were involved in drafting them knew what they were doing, and that they were based on industry standard within Switzerland. So every country has these. In terms of these control provisions that I'm talking about here, in the US, these would typically be dealt with in a series of agreements that you can access. In, say, Switzerland, it would be typically dealt with in one agreement that's essentially a shareholders agreement. So, and that's just because I guess they like to do things different, and it's a little bit simpler. There's a little bit less documentation, in my experience, outside the US. Another control provision that we can talk about is conversion, and at whose option, mandatory or optional conversion. So when we talk about, for example, convertible preferred stock, or we talk about the conversion of a convertible debt instrument, the question is, who gets to decide when and how that conversion event takes place? And if you're the holder of the convertible note or the holder of the convertible preferred, obviously, you want to control the timing of that conversion. On the other hand, the company may say, hey, look, if we need to clean up the capital structure and we achieve this predefined event, we have the right to convert it. So very standard, obviously, in connection with an initial public offering, that the company would want to convert all the preferred stock into common stock. And if it's a good deal, that's part of the bargain. So conversion is something that's important because it does change the fundamental nature of the investment, both from the investor's side and from the company's perspective, and how they can reflect it on the balance sheet.